Hello, 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 ladies and gentlemen. Welcome to Live from the Compound. One of my favorite things I get to do each month is check in with Nick Colas and Jessica Rabe of DataTrek for a little something we like to call What Did We Learn? We look at market activity, economic data over the last week or two, and we try to figure out what's going on here. Are we up to speed? Does it make sense? How does this affect my portfolio and how I'm investing? Nick and Jessica are the co-founders of DataTrek Research, the authors of DataTrek's morning briefing newsletter, which goes out daily to over 1,000 institutional and retail client subscribers. They are also two of the smartest people I know. Nick and Jessica have their own YouTube channel, which you can find a link to in the description below. How's everybody's summer going so far? How are we?
Very good.
Doing well?
Great, thank you. Yep.
Nick, is that a tan? Did you get some color this week? No.
All
right. Never.
I wish.
All right. Fair enough. So what did we really learn from this extreme but extremely short burst of market volatility? Like, look, this is a really good question. What actually happened this month in August? Because it seems like we had this really huge, sudden burst of volatility, but then it went away almost as quickly as it arrived. So talk to me. What have we just gone through? Is it over?
So I think Jessica's got the lead-off data from that, so I'll turn it over to her.
Okay.
Oh, sure. I mean, honestly, it all fits exactly what we've been talking about in these videos. August is almost twice as likely to see the VIX peak for the year as other months. So barring an unexpected
we could check
shock,
that box for this year.
Yeah. We do think 38.6 earlier this month. Yeah, it should be the top for the year. The VIX has plummeted since, closed at 14.8 on Friday. That's the lowest print since mid-July. So in terms of what's next, volatility does tend to cluster, but again, we think the worst is past. October, of course, does tend to be volatile as well, but the 4 out of 5 times that the VIX has peaked for the year, in October since 1990 was in the 90s when mutual funds were a lot more prevalent. So their October year-end date would pressure stocks because of tax loss selling. That's no longer as big. That's no longer
they're not as important
as big of an issue.
Actively managed mutual funds closed out their fiscal year in October, which meant that any end of year things they were contemplating or actually doing would take place in that month and not December, which is part of the reason why October earned this reputation for being of a more volatile than usual month. And you're making the argument that relative to the overall markets and since the growing popularity of wealth management, ETFs, things that are not doing this type of thing in October, it's not as big of a factor.
Yeah, exactly. Okay. And ultimately, I know we sound sort of like a broken record, but the stats are staggering in that the S&P has peaked for the year 70% of the time in Q4 back to 1980, and more specifically, the S&P's peaked for the year in December half the time over the last few decades. Again in December. So it's only done so once or 2% of the time in July. So it'd be super unusual if July marked the peak for the year. And again, remember that volatility and returns are inversely correlated. So as markets calm down in November and December, stocks tend to melt up. So we're still bullish through year end. We think stocks will melt up through December.
Nick, how do you see it?
Yeah, I think we've got a table to show, which shows returns for, there you go. So this is something that we showed our clients last week. We do a mid-quarter update for clients and kind of give them the lay of the land as far as how things have been performing. And the columns to focus on are kind of in the middle of this table. It's July, then the first half of August, then Q3 to date, which was through last Thursday. July, we all know, was a ripping month, right? I mean, non-U.S. stocks were working, non-U.S. stocks were beating U.S. stocks. So ACWX was up 2.2%. The S&P was up 1.1%. The small caps were amazing. The
huge rally for mid and small. Yep.
10% rally in July for the Russell, 11 for the S&P 6. And then the first half of August looks like an entirely different world, right? All of a sudden, everything fell apart, and it seemed like that was the end of this cyclical rally that we had in July. But if you look at the next to last column, the Q3 2024 to date, you'll see that the underlying trend is still positive. Small caps are still beating large caps. So Russell's up 4.3, S&P's up 1.5. You've got the NASDAQ actually in the red for the quarter still as of last Thursday. So tech is still getting rotated out of, and money's going into small caps. The international stuff is a bit of a canard though, because the dollar's weakened a lot. The euro's off 2.4% quarter to date. The British pound's up 1.6. So the euro's stronger, the pound's stronger, EM currencies are stronger. So you're getting some return in non-US investments, but it's currency. It's not underlying stock. So the message from that table and the message for today is don't be fooled by the volatility of the last couple of weeks. This rally is still in place. The cyclical rally is still in place. Financials are working. Industrials are working. Small caps are working. And as volatility comes down, as Jessica mentioned, those trends will, I think, again prevail. So the rest of the quarter will look more like July than it did the first half of August.
So I want to go back to the VIX for a second. I want to show you something that JC Peretz brought to the Compound and Friends, not this past week, the week prior, just like illustrating how extreme that VIX spike was. So for viewers who are not familiar, the VIX is a volatility measurement tool. So it doesn't have predictive power per se. It just tells you how much options activity is involved in buying protection against the market falling. And this is a really extreme number, this 65, but it was an artificial, and it had to do with the illiquidity of some of the contracts that are in the calculation of the VIX index. And so the bottom chart, which is the actual VIX futures that trade on the CBOE, JC's point was that's what the actual VIX was if we're looking at the tradable version of it. And so it's still extreme and it's still a really fast move. It's just not really 65. What do you guys make of that distinction? Is that interesting to you, the difference between an index, which artificially captures something, versus the tradable product itself, which represents people actually betting, live money? You have any thoughts on that?
It's a fair point. We did think about that 2 weeks ago when all this was happening. And look, the tradable product's always the one people should watch and really pay attention to. So, if you're, even if you're trading during the day, if you're an active day trader, you should be watching the futures all day long, not the cash print, because the futures are the things that are trading through the day. And that's where the liquidity is. And that's what's actually happening. So you might get a wonky print because something goes off on a bad trade in a big stock, but you watch the futures. And it's the same with the VIX. Other thing I'd say is that, it's a distinction without a difference, those two charts, because ultimately the average on the VIX is 20, standard deviation's 8. The minute you're getting to 30 plus levels, you're close to 2 standard deviations. It doesn't matter if it's 35, 40, or 42. It's just big. And that tells you that something bad has happened.
Yeah, 36 is a 2 standard deviation, or 37 is a 2 standard deviation move, or the print of 38.6 that we saw. That's still very rare. Yeah. And we think also that goes to show that probably was the high for the year.
So look, I always say after moments like that, it's not, whether you bought or you sold. The important thing is that you panicked. I always like to remind people, I want to roll through some of the returns since that VIX spike. So I went on TV that day and I basically said, look, I can't tell you shit about the Japanese yen carry trade. All I can tell you is a 65 VIX, you're a buyer, not a seller. That's all I like. If you know absolutely nothing else but one thing, that should be the one thing that you should know. I didn't realize how quickly that would look as prescient as it does now, but it always ends up that way. The triple Qs are up. This is as of this morning. Triple Qs are up 8.5% since that VIX spike. The Russell 1000 growth is up 8.38%. S&P up a little bit more than 6.5%. Dow up almost 5%. Russell 1000 up 4.5%. So you got this, I don't want to call it a melt up, it's the wrong term, but you just got this instant knee-jerk buy the moment we were no longer worried about whatever we were worried about 2 weeks ago. And it's just, to me, it's remarkable how quickly a lot of these charts repaired themselves. And maybe it's not so remarkable. Maybe this is what it normally looks like. I want to give you some sector level data too. Let's put that chart up. The XLK, which is tech sector, is up almost 11% since that VIX spike. The XLY 6.6%. XLF, which is financials, up 5.87%. The three worst sectors since then, it should be pointed out: real estate, basic materials, and utilities. They're up a couple of percent, but they're all up. There is no sector that's still down from the highest level of volatility 2 Mondays ago. Should I be surprised by that, or is this kind of a standard comeback whenever you see a spike of that magnitude?
It is a hyper speed comeback, that's for sure, because look, there's a reason there's a reason for that open 2 weeks ago. And the reason was you had tremendous volatility in the end, tremendous volatility in the Nikkei. And if you remember long-term capital, you get hedge fund blowups, you get financial system blowups when a currency melts up or melts down, or a local market melts up or melts down. People aren't prepared. And so there was a rational fear. It wasn't a 65 VIX fear, but there's a rational fear like, okay, something's going to break and we got to wait for that to happen. Then you wait 72 hours and wait for things to clear, and nothing broke. And then we got that good data on Thursday, and things have been off to the races since. So even if you're not trading a market, it's always important to understand why we have these, air pockets, and just to reassure yourself to know what to watch for. And that's what we told clients 2 weeks ago. It's like, if we don't get anything breaking in the financial system, we're going to be fine. So let's wait a couple of days. And if we don't, then we're fine. And we were.
So funny. Greg Zuckerman, who's a great author of books, but also a journalist for the Wall Street Journal, is currently working on a book about George Soros. And he mentioned, I guess, I don't know, this is 40 years ago, 35 years ago, George Soros blew up because of a yen carry trade going wrong at some point in the early 90s. Like, this is not a new phenomenon. It's just something that doesn't happen every day. So I guess we were basically in this situation where you had a lot of hedge funds that were borrowing in Japanese yen terms, buying assets in the United States or elsewhere. And there's this differential between the borrowing rate that makes for a high octane kind of trade situation until it unwinds or temporarily unwinds. And, there's leverage involved. So it effectively, what it ends up looking like is a margin call, but it's not in the millions of dollars or in the tens of thousands of dollars. If you think about a margin call, let's say in your Robinhood account, this is on a much bigger scale. And very often, if there's a successful trend or trade that's working, everyone's doing the same trade. So you have that phenomenon too. JP Morgan estimated at the end of last week that we've probably seen 3/4 of what they estimate the Japanese yen carry trade needs to, or people that need to unwind that trade. We've probably seen 75% of it. Does that sound like it's feasible to you? Is it something that you think about, or you don't really care so much about the size of it?
Yeah, I think we care less about the size and more about the fact that nothing broke. That 65 VIX was something's going to break, and nothing broke. And that's sort of a testament to, I think, the regulations that have gone in the past 20 years, all the focus that prime brokers now have on making sure they don't have another Archegos in their books. So I think it's all healthy. It shows like the system actually stood up okay.
What would have broken historically? A bank, like an investment bank that's a prime brokerage, somebody that's got somebody that's extending credit to traders.
It would have been a multi-strat hedge fund that had several prime brokers with whom they didn't share 100% transparency on what their positions were. And when you get a big inversion in a currency trade, or your cost of capital suddenly spikes, every individual prime broker thinks, oh, okay, we're fine. We're the only guys and they're covered. And then they find out they're not, and then they have a problem.
Were you guys surprised to see some of the moves in the Japanese stock market, or not really? They basically had a mini 1987 in price terms, and that's not a small market. It's one of the largest stock markets in the world. Were you surprised by the severity of how their equity market reacted?
Stunned.
And
stunned. And then, you see these pre-open VIX prints and you're like, yeah, I get it. I understand why that's a 60 handle. That's probably where it should be. And let's see where we go from here.
Not for you to comment on any individual company, but any idea in mind about why so much of the volatility was concentrated in MUFG, which is Mitsubishi's financial group. That seemed to be the epicenter of the panic. Is that just because it's one of the largest companies and systemically important? Or is there some other reason why that stock would have been down 25%?
One thing I've learned over the years is, don't way overthink periods of crisis. Just wacky things happen and they usually resolve.
Okay. One of the interesting things about the Japanese stock market sell-off is that from a price perspective, it basically got back to where it was in 1989. It took a really long time to get back to that price. And then as soon as it got back to that price, we had this Japanese yen carry trade unwind. Coincidence or what could explain the almost perfect symmetry between the Nikkei hitting that price twice and collapsing in both cases?
I think this is one of those examples of, people looking for a pattern to explain, the world where
Yes.
the pattern's actually random.
Oh, so you think it just randomly happened and it has nothing to do with that specific level?
I don't think there's any muscle memory left in the market from 89. Like I was in B school in 89 and every professor was writing papers about why the Nikkei should be where it was because of all the cross holdings and the industrial growth and the Japanese miracle. And that all proved wrong. So and that was one case where nobody knew, and I don't think there's any connection.
Okay, I want to ask you guys about the consumer slowdown. Jessica, you looking at companies' earnings reports and the commentary coming out of the transcripts from those reports. What do you say?
Yeah, so one thing we do is we look at Google Trends as a crowdsourced real-time indicator of demand, since consumers tend to search for a product or service before making a purchase. So we have some examples here that we looked at after those earnings calls that were indicating, slowdown in the consumer. So the first one we have that we sent you guys, perfect. This shows U.S. Google search volumes for Home Depot and Lowe's over the past 20 years. And what it shows is that searches for these home improvement stores grew steadily through the 2000s and 2010s, but spiked after lockdowns, with the 20-year peak in spring of 2020, since pandemic lockdowns led to a massive home upgrade cycle because, of course, people were spending more time at home. That clearly pulled forward demand, and search interest is now back down to pre-pandemic levels. So this, matches what Home Depot CFO was saying on the call. He blamed high inflation, some economic uncertainty with unemployment ticking up, and then, of course, high rates, since homeowners tend to finance home improvement products or projects. So the next chart we have on inflation, and this shows U.S. Google search volumes for inflation and interest rates over the last 20 years. And we think this is a super interesting chart. It shows that no one really cared about these topics prior to the pandemic, since inflation and rates were low. Searches for inflation peaked in August 2022, 2 months after the annual inflation peaked. And then searches for interest rate peaked in March 2023, when 10-year yields fell sharply before climbing to its high then, of course, of October of last year. And searches have come down somewhat, but the important stat here for this chart is that search volumes for inflation and interest rate are still double pre-pandemic levels.
It's really interesting because I think one of the things that's keeping those searches high is the prevalence of inflation commentary from both political parties. Each party will accuse the other of being the reason for inflation, or they're going to cause more inflation, or they're to blame. And so that's kind of like something that will keep it in the headlines. And I imagine the longer something's in the headlines, or the more something's in the headlines, the more people will search that topic because everyone's talking about it. So there's probably some give and take between what the media is talking about and what people are searching for.
Yeah, it also does, though, reflect some of what companies were talking about on their earnings call, like I just described with Home Depot's CFO. We have another chart, U.S. Google searches for buy car and buy house over the last 20 years. This is just another example. It shows searches for both terms grew in the 2010s as the U.S. economy expanded, but it took a step function higher after the pandemic because Americans wanted more space given pandemic restrictions. So they moved from, we had that max exodus from cities to suburbs. So they bought houses, and then also they needed cars to get around. But searches for buy house and buy car hit their 20-year highs in Q1 of 2022, and interest in both are now back to the upper band of their pre-pandemic interest. So we're starting to see a pattern here. And our last two charts, I can just briefly discuss quickly. They show the same thing. This is U.S. Google search volumes for Airbnb over the last 5 years. They peaked in June of last year, but they were down 10% from those levels in June of this year. So Americans are reducing discretionary travel as households pull back on spending. And then the last one, that's U.S. Google search volumes for restaurant over the last 20 years. It shows that searches for restaurant spiked in 2021 and peaked in July 2022 amid all that pent-up demand. But interest was down 6% in July of 2023 and down even more, down 14% year over year last month. So just like discretionary travel, Americans are dining out less. So our overall takeaway from these 5 charts is high inflation and interest rates are still top of mind for Americans, and it is weighing on their propensity to spend on everything from eating out to discretionary travel to big ticket items. However, as we saw with all these charts, search interest is really just falling back in line with pre-pandemic levels as opposed to falling off a cliff. So we think this speaks to the U.S. economy normalizing as opposed to signaling an impending recession.
Yeah, it's not that nobody is searching for Airbnbs. It's that they're not acting like it's 2021 anymore, and they need to go away every 3 months or they'll spontaneously combust. I mentioned CEO commentary, earnings transcripts, because when I looked at your charts, I said, I'm just curious if anecdotally executives on this last earnings call are confirming the things that these Google searches are reflecting. And it turns out that they are. So a friend of ours writes the transcript, which is this really great email product where basically they're just pulling out the highlights from every earnings conference call that is somewhat representative of an area of the economy. So in the restaurant example, where your Google searches show that number is now in steady decline, the CEO of ARC Restaurants, Michael Weinstein, just said, quote, it's telling where the customer's pocketbook is right now. They're sort of being stingy. And so that period of time in which they will continue to be stingy, we will not see the sales that we were used to prior to that. All right. I don't know what ARC Restaurants are. Does Kathy Wood, the chef? What's ARC? I'm not 100%, but we're seeing the same. We're seeing similar things. I wanted to share one more with you. This is Bank of America CEO Brian Moynihan. He said, quote, well, in our customer base of 60 million customers spending every week, what you're seeing is they're spending at a rate of growth of this year over last year for July and August so far, about 3%. That is half the rate it was last year at this time. So the consumer has slowed down. They have money in their accounts, but they're depleting a little bit. They're employed, they're earning money, but if you look at it, they've really slowed down. So the Fed is in position where they have to be. So searches for things like travel and restaurants, that's exactly what you would expect to have corroborated by one of the largest credit card issuers, one of the largest banks in the country. And in fact, that's what's going on. They're saying slowing down. They're not saying off a cliff or disappearing. And I think that's a really important distinction as we cycle into year 3, maybe year 4 of the current bull market.
Yeah, absolutely. I agree. And I think that's what's so helpful about these charts. They show just how unbelievably robust demand was for everything from eating out to home improvement projects to discretionary travel. Because we have to remember immediately pre-pandemic, 2018, 2019 was the end of the last economic expansion. The economy was really strong. So yeah, we just completely surpassed those levels. So right now, demand is slowing, but we're just simply returning to levels at the end of the last economic expansion.
Yeah. If you comp to something other than the immediate post-pandemic, it looks more normal than anything else when you're looking at the rate that people are searching for these terms. Nick, you want to do some Bitcoin stuff?
Sure.
Okay. You like to point out that you were the first strategist on Wall Street to seriously write about Bitcoin. And I know that's true because I was there. Why is that still so important to you because you're not a wild-eyed Bitcoin advocate per se, but you have been taking it seriously far longer than most people have. Why is that so important for you to remind people of?
Oh, because I think you're right. This is an asset that people fall in love with and think it's either the best thing in the world or the worst thing in the world. And the way we look at everything is stuff is just what it is. You can't fall in love with anything. That's the first step to losing a lot of money in anything. So you have to look at it objectively. And in particular, with Bitcoin, it's had a relatively short history, but the history is very volatile and, full of different events. And so having some historical perspective is helpful. Like the thing I hear most, or the question I get most, is which is better, Bitcoin or gold? And the answer I always give is, look, they're just very different assets. Gold is a physical asset. And half of all gold demand in the world is for jewelry. There's no Bitcoin jewelry, right? So physical demand for gold has a steady underpinning in jewelry demand. Non-U.S. central banks buy 20 to 25% of all the gold supply every year. So between those two things, you have a fairly stable source of demand. The rest of gold demand is technology, 7%, and then investment demand is like 18 to 23%. So investment demand is just about a quarter of gold demand in any given year. For Bitcoin, it's essentially all of it, which explains why gold is much less volatile than Bitcoin. Gold has a stable source of demand, several stable sources of demand. Bitcoin doesn't have that yet. Maybe at some point in the future, central banks will buy Bitcoin the way they buy gold. Maybe it's not happening yet. It could happen, I suppose. But the underlying message is they're very different assets. You're buying different things. For gold, if you're long gold, you're hoping that non-U.S. central banks continue to buy it, like we've discussed on prior calls. If you're long Bitcoin, you just hope that there is more financialization, more people use it as a diversifier in financial assets, which kind of leads me to my...
Can we pause and double click on that? I think that's such an important point. We are now 15 years into this experiment, and you no longer hear people seriously talking about use cases for Bitcoin other than investment, speculation, maybe store of value. You don't hear the critics say, I can't use Bitcoin to buy Starbucks, because nobody cares anymore whether or not you can use it to buy Starbucks. No one is saying this is good for small dollar transactions. So you're not hearing the bears or the bulls debate whether or not there's a use case. Since the advent of the ETFs, the only debate is whether or not investment demand will outpace the rate at which new Bitcoins are mined. There is no other conversation. And that conversation seems to be fairly one way, which is that, look, this is now productized by the largest firms, investment firms in the world. So there will be some level of demand. We don't know how much it'll be. And it won't be as steady as, how many tons of gold jewelry manufacturers need to buy. But we know it's at least coming in. It may be a trickle. It may be a lot at any given point in time. So now the question is it going to outpace how fast they can make new Bitcoin or not? And now that we've arrived there, I think you're absolutely right. That's the main difference. With gold, yes, it's a store of value, but you also still know that people will want to buy gold jewelry. Central banks will want to hold physical gold. These things will never, ever change. And so you have that feather in your cap. Bitcoin's a very different conversation.
It is. And actually, there's a new academic paper that was just out this month that I pulled a couple of charts from that I wanted to show you.
Please.
I think we've got them here. What the first one we've got is. Okay. This is from the paper, and I think you're going to put the link to the paper in the show notes so people will be able to check it out. It's a very, very good paper. It looks at Bitcoin returns back to 2019 to the present. And in this chart, it decomposes the sources of the moves in Bitcoin, what explains the variation in Bitcoin prices. So the top line is Bitcoin, the black line. The next level down is demand, which is what we've been talking about, demand for Bitcoin. Then the kind of purplish line is basically interest rates, what are monetary policy, and then the bottom line, the blue line, is conventional risk. Call that the VIX. And so what this chart does is show you that at various points over the past 5 years, the price of Bitcoin's been affected by some of these factors more than others. So, for example, in 2020, we highlight the March 2020 pandemic crisis, where conventional risk very high and everything went down. In a crisis, correlations go to 1 for everything, including Bitcoin. You can see that the black line dips right there over there above 2020. Then in 2021, we had this huge demand surge for Bitcoin. And you can see that Bitcoin prices track that demand surge very, very well. So that demand surge caused by excess savings and people wanting to gamble on financial assets, that worked there. Then the rate hikes in 22 were, the monetary policy shock. And that really, you can see how it kind of had an effect on the Bitcoin returns. They didn't, it felt
negative effect.
Negative effect, yeah. So a shock to rates, a shock of higher rates pulled down Bitcoin prices. So you can see that they all matter at various points, but the one that looks to matter the most is the demand side, that purple fuchsia line in the middle. So the next graph we have is a bar chart, also from the paper.
I'm sorry, can we go back to this very quickly?
Sure.
Do the purple, pink, and blue lines add up to the black line?
It's a variation analysis, so no.
Okay.
Mathematically, it would not.
Okay. So, but those they're contributors to what the black line does.
Yeah, it's important to show this is a disaggregation of the Bitcoin return data, so give you a sense of when does a factor really overwhelm the other factors. So the pandemic crisis in 2020 had a temporary but very damaging effect on prices, but they came right back as the VIX came down and stocks began to go up. Then that rate shock in 22 had an effect on prices, but that Bitcoin demand line, the second one from the top,
it looks the closest. It looks the closest to the actual.
Right.
Okay.
And the bar charts will show you, confirm what your eyes are telling you. This decomposes what affects the prices of 2-year treasuries, the S&P 500, and Bitcoin in those 3 sets of bars. The first one shows that conventional risk, the VIX, stock market volatility, and monetary policy explain about half of the move in 2-year bonds over this period. For the S&P, it's also about the same. When you get to the Bitcoin chart, you'll see that crypto demand for the product, explains 80% of variation in price, and the more conventional things, monetary policy and conventional risk, explain less than 10%. So when you're owning Bitcoin, you're owning crypto demand. You're owning a call on crypto demand. You're not really hedging any kind of other risk aside from perhaps very big shocks to rates or very big shocks to capital markets. But in general, you're owning crypto demand.
So guys, tell me what you think of this. My takeaway from that explanation is people who are spending time in search of some sort of Fed-related or monetary policy-related answer to, should Bitcoin go up or down in X environment, those people are spending their time focused on the wrong thing. The question that actually matters is, will there be more or less demand for Bitcoin? And I'm not suggesting I have a way to answer that question, but that's the right question. Will more people want to own it versus less people is more important than what will the 2-year treasury do? What will the Fed do? What will monetary policy be? Would you agree with, is that too general of a statement, or would you say directionally that's the right?
The data is overwhelmingly in support of that view. I mean, there's no other way to read that data. You can argue that the shock in rates in 22 was, a rate move and therefore influenced Bitcoin prices. But I think it was the surprise of the move. It was the surprise of the how aggressive the Fed got that hurt stocks and hurt bonds, because it pushed us into thinking we're going to have a recession. Absent those kind of shock moves, either in risk or in rates, the move in Bitcoin going forward is going to be about demand for the product, which makes sense.
It makes so much sense to me. It's a technology. It's also got a commodity element to it, supply, demand. And because there are no cash flows, why would interest rates matter to it. We're not trying to discount cash flow analysis this thing because it doesn't produce any. So the discount rate or the risk-free rate shouldn't really even enter into the conversation when we're talking about an asset like this. Would you go that far or not quite?
I wouldn't, because if you look at the historical correlation of gold prices to real interest rates, real ex-inflation interest rates,
There
there's
is
kind
something
of a
there.
decent relationship. When
Okay.
real rates are zero, it's kind of free to own anything because you're not paying any money, and you're not paying for capital. When real rates are high, it's a little bit harder. But it's a weaker link than you would think would be the case. So I think there's some argument for rates, but the data on Bitcoin is so overwhelmingly clear. This is a demand story.
Yeah. Well,
If
please.
if your viewers do want to, one way to track real time interest, again, use global Google Trends search volumes for Bitcoin, but again, do worldwide, and you'll see that outsized interest correlates with extreme moves in Bitcoin. So, for example, certain peaks in the price of Bitcoin, you'll see that the search interest chart on Google Trends is very similar, and that works both ways, of course. When the price swoons.
Yeah, I feel like if we could get real-time data of Coinbase logins without looking at a price chart of Bitcoin, we could infer it's either up or down 20% from last week when we see a huge spike in people checking their account. They're either checking it because they're terrified or they're excited, but something is, and this is where, yes, it's different than stocks, but in some way it's not very different from stocks because we're all human beings. It might have a different ticker symbol, different asset class, but in the end, it's us, and we are what we are.
A chart's a chart.
I agree. Guys, I had so much fun checking in with you. I want to remind people how they can watch you on YouTube. Guys, you can go to youtube.com/@NickColas and Jessica Rabe. And of course, you can always go to DataTrekResearch.com and subscribe. Thank you so much for joining me today. Really appreciate it. To the viewers, listeners, thank you. We'll talk to you soon.